Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments. As we do with all these chart books, I give you my in-between-the-line readings for the cut and dry analysis. Please listen into more depth to Nick's analysis. I just give you a quick overview of my thoughts. And let me just jump right into it. Market expectations here in a year from now for the Fed. This is obviously in the context of the Fed meeting. As you can see, the market is steadily pricing in higher rates a year from now. And then once in a while, there's a setback when there's a risk-off environment. And the risk-off environment, not unexpectedly, then maybe all bets are off, they may not rise. It is worthy to look whether the market reacts in this fashion, whether a sell-off, for example, recent days have seen the NASDAQ come down, expectations haven't come down. That is not a risk-off environment. When some earnings fail of some big companies, you want to see a more pronounced downturn if there were to be a change in the outlook, and obviously in this particular case, it was short-lived. Inflation readings have been coming in higher. Some of them are just because of statistical aberration, so to speak, and so they're generally shrugged off. But the trend is towards the 2% and above, with the 2% obviously being the Fed's target. More relevant, inflation expectations have also been rising. If you look historically, that's not a first and a new thing, and notably also these are market-based inflation expectations. In my experience, the European Central Bank looks at market-based expectations more. The Federal Reserve tends to emphasize survey-based inflation expectations. Now that may sound academic, but that allows the Fed to let inflation go a tad further before having to kind of raise alarm bells or push the brakes, so to speak. Then relevant, of course, with regard to the Fed is how far can this go on, how wage pressure is gradually picking up, as you can see. And so Chair Powell should take notice of that. The reason why this is a concern, obviously unemployment is low. Now that said, more and more people having been coming off the sidelines of the labor force, and there are different ways of looking at this. And this particular chart here is the prime labor participation rate, and we're not yet back at the 2007 level. So you could argue, oh, maybe we can go up this far. Mind you, any chart that one puts up, only believe it if you've constructed it yourself. Keep in mind that the overall structure is changing with more people retiring, population is aging. I believe a longer-term trend is worthwhile looking at, and now suddenly this looks a little different. Also keep in mind versus the previous chart we just looked at, that's the previous one again, this only looks at the men. Not that we favor men or women, but you tend to get a purer picture because there are different societal changes that affect this. Relevant here is, and we've drawn this dotted line, and that's not a scientific way of drawing it, it's drawn with hindsight, but my take is, and my take is also not just my own take, but Powell's take might be that we might have exhausted the pool of available labor when we cross that line, which might happen later this year, early next year. Nobody knows. The Wall Street Journal just had an article about how companies are now not asking for any prior work experience when they hire people. Does it mean there is an infinite amount of labor available, or does it mean we're at the edge there where we are going to experience more serious pressure from inflation? My own take is inflationary pressures are picking up, and the relevance, of course, is that means the Fed will have to continue hiking rates. The Fed's mandate is not to prevent the yield curve from inverting. It is an inflation mandate, and so my expectation is that as they keep raising rates, something is going to happen. Here, let's look at financial conditions. Rates are going up. The whole point of hiking rates is to have financial conditions deteriorate. Now, deteriorate might be a strong word, but the point of hiking is so that this economy doesn't overheat, right? And we do have an economic stimulus on top of a very low employment. Now, luckily, if you want to call it that way, we do have these trade tensions going up, so that is a little bit of a headwind. But if Mr. Trump strikes various deals, those headwinds are going to recede, and in any case, at this stage, they're not very strong. And so keep an eye on these financial conditions. The Federal Reserve will want to see them tighten, and then they can take it a little bit easier. That said, keep in mind, higher rates in my book mean volatility for asset prices. Tighter financial conditions mean higher volatility in asset prices in my book. And so expect some stormy weathers in the financial markets. That said, unless the financial conditions deteriorate substantially, I would think the Fed has to keep marching on. I do believe that the Fed is underpricing rate hike expectations. If you want to learn what we can do about it and how you can actually potentially profit from that, do reach out to us. We have some ideas that you might be able to do. And importantly, one of the reasons we do this is we want to project when the peak in the interest cycle is going to be, because then there might be some other opportunities investors might be able to take advantage of. But for the time being, also, one more thing here on Mr. Trump. He did, quote unquote, interfere the other day. He made a comment. He doesn't like higher rates. And many people shrugged it off and said, hey, Mr. Powell is independent. I would fully agree that the Fed and Mr. Powell are independent. Mr. Powell is not a pushover. Read my latest newsletter, the Merk Insight newsletter, if you want to dive into that in more detail. My take is that the Fed policy is inherently based on credibility. The cheapest policy is when you can move rates by words. It's more expensive to have to lower rates or hike rates. And then QE, for example, where you quote-unquote print money, is a more quote-unquote expensive version. And so when somebody from the executive branch is torpedoing Fed policy, and just imagine that the economy might be slowing next year and the Fed might have to continue hiking rates. But even if Mr. Powell is quote-unquote not going to get bullied, it does make policy more expensive because he might have to tighten more than he otherwise would. At the time Mr. Trump made those comments, bonds sold off, and that, in my view, is the rational reaction for the markets to these things. And so let me see whether I can give you the Fed balance sheet here. That's continuing to come down. It's going to accelerate a tad, and then obviously keep in mind that the European Central Bank will phase out its, or at least expected to phase out its QE late this year, and then might start hiking rates next year. The Fed dot plot projections, you can study this in more depth and Nick's conclusions as well. But do read the disclosure, and please subscribe to the Merk Research newsletters, including the Axel's Take, as I may call it myself. And look forward to hearing or listening to you next time. And please give us feedback. Thanks, Dan.